Hello and welcome to Bridging Troubled Waters, the impact of COVID-19 on investment strategy. I am pleased to be joined with our special guest speaker, Stefan Kind, a partner at LGT Capital Partners, who David will be introducing in a moment. We're going to be discussing managing a multi-asset portfolio in volatile times, balancing the key and sometimes contradictory objectives of capital growth, income generation, with appropriate diversification. Over 30 countries have registered for this webinar. It's such a pleasure to welcome you all and to have such a distinguished group of guests that are attending us in this session today. There will be a live Q&A taking place. Feel free to submit questions as they come, but the Q&A will be addressed towards the end of the session and will be moderated by David. I'd love to also introduce our host and moderator of the session, Mr. David Gibson Moore. David is the president and CEO of Gulf Analytica, a financial consultancy based in Dubai, and currently holds a number of other board positions at financial institutions. He has an extensive career experience ranging from general management at GM and chairman level at banks in Switzerland, Luxembourg, and other European domiciles, spending much of his time with JP Morgan Chase. He has experienced investment banking and project finance in London and New York, creation of private banking networks in New York, US, Europe, and the Gulf, institutional sell-side experience with major funds, including sovereign wealth funds, and multilaterals in the Middle East and Asia, including China. He also has extensive experience of Sharia-compliant banking and investment gained in Kuwait and Saudi Arabia. He graduated in physical chemistry at Oxford University and holds an MSc in financial economics from the University of London. David, it's such a pleasure to have you as always. Without further ado, I'll hand over to you and for you to introduce the session and to introduce Mr. Kind.
Thank you very much, Zach, and welcome to our global audience for this discussion. Very good to be with you this afternoon from sweltering Dubai. I think that our topic is very relevant. And the problem is when you read the financial press regularly, as indeed we all do, it's practically impossible to discern any common threads. Contradictory views as to the market are expressed every day by experts of every shade and color. We saw a 35% drop in the S&P 500 in March, much of which has been subsequently recouped. Is this a bear market rally, or is it the start of another bull market? V-shaped recovery, or U-shaped, or even W-shaped recovery? And above all, we do know that the virus is not particularly interested in what the governments or the central banks are undertaking. So where do we turn? I can think of no better person to discuss and elucidate some of these issues than our guest today, Stefan Kind. Stefan is a partner at LGT Capital Partners, where he is responsible for multi-asset solutions. He oversees more than 17 billion in assets. And for more than 10 years, he's been responsible for the portfolio management of the Princely portfolio, which is one of the largest endowment funds in Europe. And Stefan, apart from his key responsibilities with the Princely portfolio, is also responsible for selecting and monitoring key external managers for various LGT strategies, particularly in the area of emerging markets. So very good to have this discussion with you. And just to recap quickly on one point that Zach raised, we will have plenty of time for questions and answers later on. So please do add your questions, anything you would like to raise on the questions tab on your screen. So Stefan, LGT Capital Partners is the asset management arm of the LGT Group, which in turn is wholly owned by the Prince of Liechtenstein Foundation. By way of background to our discussion, could you tell us more about the LGT Group endowment and the Princely portfolio?
Sure. First of all, obviously, very warm welcome and thanks for having me. Obviously, I would have preferred to meet you all in person, but in times like these, I think this is pretty much the second best thing. So sure, happy to share with you some of the history of the genesis of this group endowment fund we are running here, or also the principal portfolio as we also refer to it. Principal portfolio because really the initial starting point was really to build a portfolio, a family office for our shareholding family, the princely family of Liechtenstein. That all started a bit more than 20 years ago when the family decided to sell some businesses and made a proceed, quite a significant proceed of roughly $1 billion US, which back then was a significant amount of money. These days, obviously, you hear more the trillions rather than the billions if you're following the press. It was not only a substantial amount of money, but really also the first time when the family had to invest such a substantial amount into liquid financial markets. So really the need to build up an investment strategy and a family office, so to speak. So we got the mandate from the family, and the mandate maybe to also quickly mention is really to have a sustainable capital growth, so equity-like returns, we can say, but with much lower volatility, lower risk, and in particular a broad diversification. As a family who went through 700 years with many wars, they know definitely the benefit of diversifying assets. You can imagine that when starting, we were also approached by a lot of investment banking firms. They all have had very good ideas how to invest that money. But at the end of the day, we found the approach of the largest US endowments at that time, like Harvard, Yale, Princeton, and the likes, probably to be best suited to really fulfill that long-term mandate from the family. I think most of you may be familiar with that approach from the US endowments, but in an essence, what are the kind of the key pillars? First of all, and that's very much true for our strategy as well, it's a long-term orientation, a focus on strategic allocation rather than short-term timing. Secondly, a strong belief in active management, and when we talk about active management, we mean, not only not going with passive indices, but really like when you think of private equity, for example, adding more value than just at the right time buying and selling, but really working with the company, have an active contribution and contributing and adding value for the investment and assets in the end of the day. As a result, our strategy also heavily invests in alternative asset classes, particular also a set of private market assets. And finally, a third main pillar obviously is diversification, where we are a big believer in, and diversifying not only via different asset classes. In our view, diversification requires really looking through the asset class exposure to the underlying risk factors and making sure also in stress testing that those risk factors are enough diversified, not having a negative impact, also not in markets like we are facing right now. Maybe to add to the strategy, I think one additional element is what we call alignment of interest. And that really goes back to the decision really early on in 99 that the family decided also to open up the strategy for external outside investor if they have a relationship with LGT, with the LGT group. And as such, over time now, the strategy grew from that initial 1 billion to around 12 billion as we speak, of which roughly 3 is the stake of the family. So we are managing the strategy now for 20 years, obviously went through a number of crises and can definitely add one more to that list right now. And I'm particularly also saying we, I think that's also important to mention. I'm part of the team running the strategy, but it's really a team approach here at LGT. We are not, buying into and believe into having a investment guru who all calls all the shot. I think this is one element, managing as a team, which also makes it more robust over time.
Thank you very much, Stefan. If we could turn right away to the core of our discussion now, the really immense and unprecedented challenges created by the outbreak of the pandemic. I think the current environment is frankly unlike anything we've seen before in our professional lifetimes. Stefan, you've had to take into account an immensely complicated matrix of information, incorporating probably many unknowns. Could you tell us how you've addressed this enormous challenge and how you've arrived at your base case scenario?
Sure, and fully agree with what you said, David. There are many unknowns and still many unknowns as we speak. But also, to be fair, we are now 3-4 months into the crisis, and we had to deal with the full set of uncertainties at the beginning. By now, at least we have some more knowns we can also look at. We know how the virus is currently spreading, and it still continues to spread quite significantly if you look at the infection rates really across pretty much every country, although every region had its own kind of timeline here. We now really starting to see the social and economic impact, which has been drastic. And I think one number which still strikes me is that close to 40 million people in the US lost their job. So in an essence, a decade of job creation was lost in just 4 weeks. And you also see now really coming in when you look at the earnings of companies where, by and large, they are a third down. But if you look, for example, at some small cap companies, they're down as much as 70%. So that definitely adds to the fact that we are going through the deepest recession right now of all of our lifetimes. Now, another known factor by now is that we had a unprecedented amount of stimulus measures from both central banks and governments. These are really, in terms of scale, new dimensions. But I think what is also important and a big difference to previous, let's say, policy responses is that it's much more better coordinated. And that's not only across the region and countries, so not only the Fed, but we also ECB, Bank of Japan, other central bankers adding to the global stimulus in that sense. But it's also better coordinated between central banks and governments. So in that sense, monetary and fiscal policy. And it is altogether quite powerful as you can imagine, and as you also see when you look at financial markets. The final known factor when we currently observe is that a lot of regions now easing the lockdown measures and going back to stepwise and gradually back to normal. And you also see some industries and activities really improving very much from their lows. So we believe it's also likely that it's not only the deepest, but maybe also the shortest recession we ever experienced. Having said that, there are still a lot of unknowns, and there's a good reason why the VIX index, for example, still is double as much as it normally is. And obviously, when we talk about unknowns, the thing which comes to our mind is second wave. That's the big question mark. Here, really, we also don't have an answer to it. Even when we talk to medical experts, they don't know exactly the criteria, what is with regards to a significant second wave. We believe it's a bit premature to already state that there is a second wave. If you look at Asia, parts of Asia which had renewed cases, they are more situation driven. And in the US, that was, for example, also triggered the sharp sell-off last Thursday. Their states were mentioned like Florida, California, Arizona. But if you look at the numbers there and the statistics, you see they're more coping and managing the first wave rather than dealing already with a second wave. So in our view, a bit premature, even if, and that remains obviously the big risk scenario, the second wave, we believe it's our view that governments will not put in place the same harsh lockdown measures, and as such, the impact to the economy will be less. What is another unknown, and that's more kind of the positive surprise scenario in that sense, is how successful can testing and tracing be on one hand, and then obviously the big question when it comes to a vaccine. Now, on the vaccine side, we are a bit more skeptical. We obviously see that it's a huge international effort, many countries doing a lot of research to that end. But if so far, at least when you look at MERS or SARS, a vaccine for a coronavirus have not been so successful. So there we are more on the skeptical side. Now, putting that all together, our base case scenario is that we have that recession, we will have a strong recovery. We will probably not go back to 100% of pre-pandemic levels when it comes to economic activity, but close to that. So we call it, internally, we call it a 90% economy. And what we also see with that, that we will very likely see not new trends to emerge from this crisis, but rather an acceleration of existing trends which have already been in place before this crisis.
Thank you, Stefan. I think your comments really do shed some light and also really emphasize how incredibly difficult it is to assess the full impact of the pandemic on the economy and financial markets. You've got so many known unknowns and unknown unknowns, and we're probably unlikely to go back to the previous normal anytime. And the healing and recovery will depend on the impact and duration of the containment measures. Stefan, how did you manage the LGT Group endowment portfolio through this recent period of intense market stress?
Sure, maybe before going into that, definitely maybe also to the benefit of everyone dialed in. I mean, our portfolio, given the mandate of have sustainable capital growth, invests also significantly in equity risk. So if you look through, you have roughly half of the portfolio invested in equities, i.e. either public or private equity. And on top of that, you have different other risk factors which have been affected obviously by the market developments this year. So definitely our portfolio was also not immune to this market shock. And so normally when you have these extreme equity moves, our portfolio participates some 40–50% of it. And that's both true when the market goes down or markets go sharply up. Now, I know that everybody and all people like to focus on how did the portfolio did in these kind of market environments. But if you really look through and the long-term results, then you will figure out that these periods don't matter much either in absolute or in relative terms. For a endowment portfolio, is much more important to achieve a asymmetric profile, i.e. losing less when equities are down and gaining more when equities are up in normal periods of time when fundamentals matter. This will at the end of the day result in a superior return versus equity. But having said that, obviously also a long-term investor should not hide from volatility, and actually obviously the investment decisions you take in periods of market stress, so in March, in April, they can be a very decisive factor of your long-term results. So what we have been doing? First of all, I think a very important element always, but particular in markets like this year, is active rebalancing. So maintaining your target risk level, although that is emotionally quite often difficult, particularly when markets are in free fall. But that is an important element in our point of view, and something we did also over this period of time. And that's not only true when markets go down, it's also true now when markets go up, like in May, beginning of June. So you're constantly selling now a bit of your equity risk to keep it at your target level. And that allows you to not only be overexposed when market correct, like they did last week, but then again buy into the market at a bit lower prices. Now that's the first thing, rebalancing. Second is you early on want to start look at opportunities arising from the dislocation. And here's something we probably also learned from previous crises, that the pattern is quite similar. The first, obviously, opportunities are in the very liquid space, which have just been sold off. So what we did as early as in March is we built more strategic midterm additional positions in equities. And for us, both the Japanese and the European equity market have been triggered first and really showed extremely attractive valuation for us as a long-term investor. Now, thirdly, and that's kind of the third element, what we did so far is really focusing on the credit market, where also we expect different phases. In the initial phase, you really focus again on the liquid. Having said that, this time, the very liquid space, so investment grade bonds, high yield bonds, the window of opportunity was only very short because the Fed stepped in with massive buying, and that immediately had its effect on the market. But other areas such as CLOs still at attractive price. And what we also do when we talk about credit is really preparing for the next distressed cycle by, with our external managers, building up dedicated mandates to benefit from distressed situation going forward. I think that's overall a bit a summary of our activity when it comes to investment decision. Next to that, obviously, it has been important to be in very close contact with our specialized niche manager, which we appoint in this strategy, both on the public market side, but also particular on private equity, where we really wanted to understand what is the impact to our portfolio and also the opportunities going forward.
Thank you, Stefan. You've just touched on one aspect. I wonder if you could just comment a little bit further on the sector impact of the very harsh economic conditions and scenario that we find ourselves in. How are you taking this into consideration? Are you selecting underlying managers for specific sectors? At all, adopting a sort of kind of fund-of-fund approach, or are you indeed making even specific stock selections yourself, LGT on the portfolio?
Yeah, probably I should have mentioned it early on in the beginning. I think one aspect of our investment strategy, and again, similar to many endowments, is that we work also together with specialized manager in niche markets. So a big part of the strategy is not run by ourselves when it comes to stock or security or deal selection, but by external managers. That's particularly true for areas such as private equity, but also on the hedge fund side. A good third of the portfolio, 1/3, we manage ourselves by, again, executing different internal strategies, be it mostly on fixed income and on the equity side. So 2/3 external managers, 1/3 in-house. When it comes to sectors, to your first part of the question, there we don't take particularly strong sector views. So we tend to give out broader mandates to managers, and in that sense, they, their alpha capability of decide not only on the bottom-up stock selection, but also on the sector weighting. Where it is more true is obviously on the private equity side, where, given, with private equity investing, also specialist in niche market, you end up overweighting some sectors such as IT, healthcare, also consumer discretionary, and you're underweight other sectors such as oil and gas, for example, which is also something we believe is a winning strategy going forward, with this crisis also really accelerating these trends, which have been in existence before, but will be probably more pronounced going forward.
Thank you very much. As you said, I mean, some sectors like healthcare and pharma, information technology, and even utilities could even benefit over time from this present situation. And thank you for commenting on that. Stefan, I think the core of your strategy is the building of a resilient multi-asset portfolio. We've touched on this a little bit already in the discussion, but in addition to the main public asset classes of equities and bonds, you invest in a number of private asset classes. Mm-hmm. And within this category, as you've touched on already, private equity, I think, is critically important. Could you characterize how the present conditions have impacted this very important asset class?
Sure, you're right. Private equity is a significant allocation, always been. We started with a 20% strategic allocation 20 years ago, and also increased it further. Maybe very briefly, what we do here are, on one hand, mainly primaries, i.e. investing in private equity funds, but we also add a secondary transaction, i.e. acquiring private equity interest on the secondary market, and even do co-investments, i.e. invest in companies alongside our manager. And the main role of the asset class is really to enhance returns, to be quite frankly. And when what we experienced, for example, over the last 20 years, that we can, with the illiquidity and skill premia, add a excess return of 4 to 5% over the public equity market. And that's mainly achieved due to the active management of private equity, i.e. going into the companies and adding value. Now, when you look at the impact of this crisis, particular to private equity, I think it's obviously not as easy to see early on as in the public equity market, because you don't have any daily price of these companies, privately held companies. But us being a very long-standing and sizable investor in the space, obviously have a significant network. And what we did in the private equity team, we contacted any of our private equity manager and really went through the entire book of portfolio companies. So overall, the team made a couple of hundred calls with all the managers, went through all the underlying companies, and really looked how they are impacted, particularly in terms of liquidity, obviously, but also in terms of supply and demand. What we saw is that roughly 80% of our underlying companies, when we look at the biggest 150 companies we own, have a low to medium impact to be expected. And only 20% or so are more severely impacted from the crisis. Again, this can be due to liquidity or other measures. We normally tend to be quite conservative by our assessing here, and obviously this is very fluid, and we expect also that rating to improve, particularly now with the government and other stimulus measures or supporting measures from governments taking place in the meantime. What we also did is we looked not only at the current situation, but also how, let's say, buyout transactions did in the past. And what we see there is quite often that the vintage years in private equity going into a crisis, so let's say the 3 year before a crisis, tend to have lower returns, also higher loss ratios than normally. But at the end of the day, if you, for example, look at our vintage year records of 2005, 6, 7, so prior to the financial crisis, they still end up on the high single digit in terms of your analyzed returns, but again, below what we normally expect from the asset class. The flip side, obviously, is then that the investments private equity managers can undertake now, at the midst of the crisis and also in the years to come, normally tend to be quite profitable. And one example here is that when we entered into the financial crisis 2008, we launched a secondary program. We also invested from the Endowment fund, and that returned a nice 20% IRR for our strategy since then. And by now, we also launched the 5th generation of our secondaries program, again, committed a sizable amount to that, and that will now be invested over the next 3 years. So in bottom line, and to sum it up on the private equity, I think for us, the aspects which are key is that we have the information. That's the first step. So stay close with the manager, get a very good, picture of your underlying exposures. Secondly, really have dry powder and also the access to private equity managers which are cycle proofed. And then finally, be patient. Particular now we think that as the cycle evolves, there will be more opportunity, and we tend to want to have more clarity and of the overall picture before making additional investments here.
Thank you, Stefan. It's a very interesting questionnaire you made reference to. Did any of the respondents indicate that there might be, and I guess this probably could be short term even, but a decline in deal activity? And of course, several exit options might be closed in the present environment. And the other aspect is you might get a mismatch of calls and distributions in the short to medium term. Did these come up at all in your questionnaire?
Yes, definitely. And that's also something we totally expect and learn from previous crises, that we will have short-term, really a wouldn't say immediate halt, but definitely a reduction in deal activity, and also respective distributions. At the same time, also less capital calls from our manager. Normally, what we see is that when normally an investment period is kind of 3 years, we expect now going into the crisis that would probably be more 4 or 5 years, where people and managers will take time to invest the money. And same true for distributions, which also probably will need another 1 or 2 years. One of our manager, I think, put it nicely when he said, at best for private equity, 2020 is just a lost year, and everything is kind of postponed by one year. But reduced exit deal and also investment activity is definitely something we expect. And that's also something where which you should, when you allocate a significant part into private markets, private equity particular, I think for any portfolio it's important that you define wide bands around your target allocation. That's not only because of that aspect of cash flow, so to speak, but also of something which we call the denominator effect. What I mean, in your multi-asset portfolio, when equity markets tank, go down, and your private market being more robust, more stable, also due to the valuation, delay in valuation, your quota suddenly goes up, shoots up. And what you don't want to do, never want to do, is kind of, in terms of risk management or whatever, say, look, the quota, if once it goes up, I need to sell it in the secondary market, because obviously prices are not attractive at all in periods of stress. I.e., the way how we deal with that is, again, having wide bands around a target allocation, but then really look through and manage the risk factor with on the public side, on the liquid side, i.e. equity risk we can manage easily via our public exposure or even with derivatives such as equity futures. David, still here?
Yeah, thanks. You were cut off just momentarily, Stefan.
Okay,
thanks
sorry.
very much. Thanks. I'd like to move on to the questions and answers sessions quite quickly, but just a couple more questions for you, if I could. In addition to private equity, you also invest in more liquid alternative asset classes. And I'm thinking here of hedge fund strategies and insurance-linked investments. Hedge fund strategies have had a bit of a bad press over the recent years for performance reasons primarily. Can you elaborate on the role of these asset classes in the portfolio and how, in your perspective, they performed in this turbulent market environment?
Sure. I mean, this really goes to the question of proper diversification. And as I said, that's something we want to maintain at all time. And for us, liquid alternative or hedge fund strategies play an important role here. But what we want to achieve with that allocation is that we have uncorrelated returns, i.e. returns which are not dependent on different market environments. And at the same time, a expected return, which is higher than, for example, government bonds. That's also why our bond allocation is quite low in the portfolio, not because we are not believe in the diversification benefits from the asset class, but just given the fact that we don't earn any money in the long run with it. So we prefer much more uncorrelated return sources where we also can expect a return of, let's say, LIBOR plus 4 to 5%. Liquid alternative hedge fund strategy is one element where we differ between discretionary strategy, i.e. more fundamental security pickers, and then also systematic strategy, which try to capture alternative risk premiums, established risk premiums such as momentum, carry. Trend following is one of the most known strategy here, which also delivered good results into the crisis. Maybe another element in that camp of what we call liquid alternative are insurance-linked strategies. For those less familiar here, what we do in essence is we buy tail risks, natural catastrophe tail risk from insurers and reinsurers. So in an event of a huge catastrophe like a hurricane or an earthquake, we might lose assets, but in absence of that, we earn quite a high premium on it. And the beauty of that asset class is, next to the return element, really that it's truly uncorrelated to what happened in financial markets.
Yeah, thanks very much. I'd just like to ask, if I could, Stefan, one more question before we go to the question and answers.
Sure.
What useful lessons do you think have been learned from previous crises over the last 2 decades? You've been through them. What lessons can be of use now? And I'm thinking particularly of the bursting of the dot-com bubble in 2000, 2001, and the great financial crisis, of course, in 2008, 2009. Yeah. Are there lessons we can learn from those crises?
Probably have to disappoint you in the way that if you look at the crisis itself and the economic impact, it's really a specific one. So in our view, less comparable to other crises we had before. In our view, it's not kind of a warlike situation. You might think of it, if you look at the policy, from a policy point of view, yes. But if you look at the economic indicators such as employment, production, demand, inflation, it's pretty much the opposite. And we also don't see it as a structural break like 9/11 or the great financial crisis, but as I said, rather a temporary demand and supply shock, which rather accelerate existing trends than really structurally bringing new trends. And when we look at those trends, and maybe that's one point to make, which we believe will be further accelerated than, but already have been in place before. I'm thinking of big government, i.e. financial repression. I'm thinking of more a deglobalization and higher, tendency to protectionism. But then for sure also internet economy, and on top for sure also a more greener and sustainable way of not only investing but also conducting business. When you ask me, or look, what we also think of what could potentially be new structural secular trends from this crisis, I think something we definitely monitoring is saving rates from consumer. That would be definitely a game changer if we would have continuing higher levels of saving rates, and maybe also on the corporate level, less spending, less investing. That's something to look at. And then definitely also more what could the longer term impact of this enormous stimulus could be in terms of inflation. These are kind of definitely the two elements we are monitoring quite closely and could materialize as longer term. So having said that, no blueprint from previous crisis in terms of kind of the crisis itself and the economic impact, but what is quite often where we recognize a pattern is in investor behavior. And obviously that's very important when you think of what financial markets are doing. There, obviously we see parallels to previous crises, and what has our lesson learned from that been, and we looked at the financial crisis in particular quite intense in the aftermath and questioned ourselves what could have we done better. I think our conclusion is that it's very hard, if not impossible, to time the down market, the downtrend and the down market, i.e. although appealing to lose less, I think for a long-term investor, it's much more important to focus of really taking the opportunities out of the dislocation. And to that end, we also developed in the aftermath of the financial crisis a systematic monitoring framework which indicates to us when certain asset classes trade at extreme attractive valuations.
Well, thank you, Stefan. Now, I must say we've got some very interesting questions for you. The first is from Carlos Moreira. Thank you, Carlos. Why is the stock market rallying in this economy? The disconnect is obvious. Could you comment on that, Stefan, please?
Sure. I think a lot of that has to do, first of all, with the action of the central banks in particular, but also the governance on the fiscal side, which really, because at the end of the day, the stock market is really just dependent on what people are willing to pay for a certain asset or, let's say, a company. And if the investor trusts and believes that the Fed is the lender of last resort and put a floor on the decline in the markets, then also that's what's happening. So as long as the trust is there towards those policymakers, and currently it is definitely the case, there is such like a floor. What also is, I think, important to mention here is that a stock market investor really discounts the future earnings of a company, and probably the real economy obviously now has to cope with what's happening in 2020, maybe 2021, where obviously earnings and revenues which will be much down from what we have seen in 2019. But the stock market is kind of like looking ahead of that into 21, 22, and so on, and pricing already in that development, which currently the also consensus is that we are getting back and have a strong recovery also in economic.
Right, but of course the government actions that have been taken have got huge longer term consequences, haven't they, that probably are not yet factored into the immediate prospects of investors. But let me just move on to the next question from Hechler-Fayd'herbe. Thank you, Hechler. This is a bit of a long question that's going to certainly need a really big picture answer. The question is, the social fabric in many countries is tearing apart as the weight of depression-like situations widen pre-existing fault lines. Will that impact financial markets by breaking down commerce as a result of revolutions like the French Revolution and the Boston Tea Party? In such a case, old financial market interlinkages may not work. How much probability do you assign to such an event?
Not sure if I fully understood the question, to be honest, but I think these are definitely scenarios, if I understood it correctly, which are very severe, and we try to partially capture that in applying also scenario fatigue. So look at different scenarios, also including this kind of outlier scenario. Outlier scenario meaning a very low, if really close to zero probability, but obviously huge impact. To that end, I think one element, if I understood it and got it right, also this kind of increasing outcry over social inequality, and that could lead into a breakup of corporations. That's definitely something we have in our set of scenarios. I think was also mentioned last couple of months with the demand that Amazon should be broken up. I think that could have a severe impact to these larger cap. Overall, for the economy and also for the stock market, doesn't mean that it has to be a very negative development. If you look into let's say Standard Oil, when that was broken up, the subsequent kind of smaller parts of it also did very well. So overall, I think also monetary debasement is another outlier scenario. So when people really lose the trust into the fiat currencies, we look at that scenarios, we include it also. I think at the end of the day, it's also important that you don't want to invest too close to the government. So government bonds also for that reason, something which we keep on the lower end, but rather try to acquire parts of high quality companies. I think if you think of the main kind of bigger devaluation risk scenarios, hyperinflation, and so on, I think that's probably on a very long-term strategic way of looking at things, the best way to protect your asset, i.e. diversify and invest into high quality company.
So we're not in a Boston Tea Party scenario quite now, in spite of what's happening in the States. Stefan, this question I'm going to ask you, you can put any disclaimers and qualifications you like on, but it comes from Kamal Puri. Where do you see the S&P by the end of the year?
Oh, that's obviously, that's the $100 question. The S&P, as you pointed out, lost, I think, 35%, recouped all of the losses. Our kind of, from a more tactical, more short-term view, is that we very likely our view, as I said, is more to have a range trading from where we are now. So where we have positive and negative news creating higher volatility. So we see volatility to stay there. But this really also my guess would be that we are not far away from where we are currently. So around where we started the year. At the end of the day, it's still a recession, and I think prices should and will not rally from this point onwards significantly. I think a lot of positive news has been priced in, including the entire stimulus measurement. So my guess, or our guess, would be that we have more range trading, and as such, our current positioning is also to have a neutral weight to equity, so neither over or underweight, and actively rebalancing that quota. So always when we see a drop of 5% or so, buy into it, but then also at the same time take profit when markets go up.
Right. Thank you. I've got two questions that I'm going to put together because they're a little bit similar. One is from Martin Buitela, and the other is from an anonymous attendee. Basically, the question is, what can you recommend in terms of portfolio allocation? Bonds, gold, cryptocurrency, stock, or other currencies? And that links into Martin's question about diversifying assets and what role does gold play in a portfolio?
Okay, then maybe let me start with gold. We currently have a 5% allocation to gold. I think gold is a great stress asset, a crisis asset to have, and as such, currently also we think it plays its role in the portfolio. At the same time, it's a very volatile asset class. You can think of it like a single stock you're holding, and as such, you don't want to have a too high allocation to gold. Strategically, we are not investing in gold. So gold, if you really look at it from a very strategic level, long term, there's just a missing income component, i.e. at the end of the day, you end up earning as much as you lose on inflation, but that's it. So strategically, not. But as I said, for a couple of months, we are into gold, and I foresee it also that we will hold on to it for a couple more months, if not quarters, as long as uncertainty and volatility in markets is as high as it is currently. To other elements, I said stock is something I think everyone is probably the place to be. The entire central bank action, and if you listen to Sharon Powell and others, that just augmented the TINA argument. There is no alternative to equities at this point in time. So having a decent allocation to equity, I think, is definitely something a long-term investor should have. In terms of currencies, our, again, is more even a strategic long-term opinion is that an investor should not spend too much of his risk budget on currencies, because again, currency are extremely volatile, take a lot of your risk budget, but at the end of the day, don't deliver you with any longer-term expected positive return. So to that end, we recommend that investors hold most of their assets in their home currency, i.e. hedge most of the foreign exchange risk. US dollar can be again a diversifier, a hedge for non-US investors, but that's pretty much it. We currently also have a small allocation to the Japanese yen, but again, more from a risk diversification standpoint. Cryptocurrency is something, I wouldn't say that we are experts in the field, and we probably tend to take a more cautious stance on that innovation. But what cryptocurrency, where we definitely can use cryptocurrency exposure, is more on the trend following strategies, because similar to other newer asset classes, the trend tend to be stronger than in others, because it's very much driven by herd and behavioral finance aspect. So if you look, for example, into the Bitcoin, you see extreme moves, and these are exactly assets which can be exploited by trend following strategies. So yes on that part, but wouldn't recommend either strategic nor tactically to go long any cryptocurrency.
Okay, thank you, Stefan. I think we've got time for just two more questions, and these, are picking up on some of the interesting points I think that we had in the discussion. But we've got an interesting question from Ahmed Abdullah Kanu relating to investment in private equity. And he wanted to know, are there delays for capital calls throughout all strategies? I wonder if you could just comment on that aspect with respect to private equity. It's quite important, actually.
Sure. We see it really across the board that investment activity in this first phase of the crisis was significantly reduced. If you think of it, it's really also due to the fact that our GPs are now very busy with managing the existing underlying companies in terms of making sure that there is enough liquidity to survive, to maybe now even look at strategic partnerships, other elements to really make sure that they can continue and ramp up their business as soon as possible. That's their main focus. But at the same time, we also expect investment activity to pick up again now when the certainty becomes a bit higher. I think one manager also mentioned that as long as the fog is so as long as it's so uncertain as currently, doesn't make a lot of sense to invest, to start too early and too significantly in the investment. And that's really what we see across. It's a bit different in terms of the regions. Asia, obviously, being first here, not only on the lockdown, but then also on the easing of the lockdown. There we see investment activity picking up, but not so much on the rest here in Europe and US. That's on primaries. Also on secondaries, that's when we kind of pick up private equity interest. The secondary market, again, there we also expect that only to come back probably September, October this year.
Well, thank you. We just got one more question, and in fact, there are several other questions we could, but I think we're running out of time now. But this is a more general question, and it's from an anonymous attendee. Can we still consider the markets as free markets, or should we get used to the central bank as a new, unequal, permanent player in the market? I think this refers to the Greenspan put, or the Powell put, as we should say now. Why not taking as much risk as possible if the Fed will save the economy anyway?
I think it's a very good question, a very fair question, and definitely something where you can take a side. Also, we believe that they have a very strong, obviously, impact into what you could call a otherwise free market. But they also, at this point, more also replacing the corporate itself. If you look at, for example, share buybacks, you could also argue how much of a free market it is when the companies just buying their own shares in order to maybe make sure that price is not falling too much. That has completely gone on, not completely, but significantly less so. That companies' share buybacks will go down significantly. On the flip side, yes, you have the central banks flooding the economy with liquidity. It is a novum. It never has been the case that the Fed, as announced this week, go and buy single corporate bonds. So far, only bought ETFs, so they're directly interfering, if you want to put it that way. And that could obviously also in the longer term result in the fact that a lot of companies will survive despite the fact that they're not producing and not being profitable enough, rather than just producing as much to bear the financial financial costs, and that could lead into more, as we call, zombie firms. Also something we saw and still see in Japan, where a lot of companies still exist, although probably without government intervention wouldn't do. So our view and stance here is that this offers more room for also active management rather than passive index investing. And similar to the financial crisis, where the banks have been obviously maybe the prime sector of government support for the next decade to come, is probably better again to not invest too closely with the government, but rather in sectors which really are can self-sustain also after such a crisis as we just had.
Well, thank you very much, Stefan. This has been extremely interesting. If we were meeting in a physical environment, we'd give you a big hand of applause at this time. But
Thanks.
Unfortunately, that's not possible. I don't think on present Zoom
Okay.
technology. But anyway, I'll hand you back to Zach. And thank you very much indeed, Stefan. Thank you, thank you.
No, it was my pleasure. Many thanks.
Stefan, David, this was an excellent seminar. I really appreciate you both. Understanding more about bridging troubled waters, the impact of COVID-19 on the investment strategy, taking that from the perspective of a manager running an endowment model strategy was extremely insightful. Understanding how uncorrelated assets play into building a portfolio that can bridge such troubled waters. One of the points that we touched upon was the acceleration of the existing trends that COVID has been bringing on, rather than necessarily creating new trends. And I would like to invite everyone to join our next webinar, which is taking place 1 week from today, Investing in Supertrends. This is being done in collaboration with Credit Suisse, with the Chief Investment Officer of their International Wealth Management practice, Dr. Nannette. That will be taking place on the 24th of June. I'd love to see you all there. I cannot thank you enough, Stefan and David, for hosting us today. Thank you so much, everyone, for joining.